I would now like to review the cash flow statement. It's only an introductory review. We will be studying this in very much detail in the second half of financial reporting. There are two ways to prepare the report. There's the direct method and the indirect method. The indirect method is the most common. The indirect method will start with cash flows from operations, which would be the net income. And then they make adjustments for non-cash effects. And the most common adjustments for non-cash effects would be depreciation and amortization expense. The reason they are considered non-cash effects is because depreciation expense recognition and amortization expense recognition does not involve cash. It reduces the net income, but it is not a cash outlay. And when we prepare the statement of cash flows, whether it's the indirect method or the direct method, we are trying to determine the actual amount of cash used in the 2021-2022 current year, or for example, in your target, it would be the 2017 year. And then the next section in calculating net cash flows from operating activities is called changes in operating assets and liabilities. The operating assets are the change in the current assets when you compare the prior year, 2016, current assets and liabilities to the current year, 2017. Now, you won't actually see that calculation when you look at the statement of cash flows for target. In 2017, that change in, let's say, accounts receivable would be what it was at the end of the prior year and what it is at the end of the current year. It just shows the net change. So in this case, there was an increase in accounts receivable, which is subtracted, okay? The subtraction means it reduces the cash, okay? An increase in prepaid insurance, the parentheses means it was a decrease in cash. And your current liability increases in accrued liabilities and income taxes are increases in cash. I will explain to you the process of determining these amounts when we study the cash flow statement. But what I want you to know is that the net cash flows from operating activities is $49, and it's the 45 plus the 8 plus the net of 4 would give you the $49, because the depreciation expense is an add back, and then you would subtract the 12, the 4, the 7, and the 5, and that would be a negative 4, so it would be 45 plus 8, which would be 53, minus 4, which is 49. In the target problem that you are doing and looking at the financial statements, they were going to ask questions. What is the highest outflow of cash in the net cash flows from operation? Well, the outflow of cash would be the reduction of cash of $12. What is the major inflow of cash? The major inflow of cash would be the increase in accounts payable or accrued liabilities. Or you can consider, they could say, well, what has the largest increase in calculating net cash flows from operations, and it would be the add back of the depreciation expense. Now, the other two remaining sections of the statement of cash flows is your investing activities. Your investing activities is the analysis of investments purchased or sold. If you purchase the investment, that would be a use of cash. If you sell the investment, that would be a source of cash. You would look at the other long-term assets, property, plant, and equipment, and also notes receivable. Long-term notes receivable would appear in cash flows from investing activities. A sale will be an increase in cash. A purchase will be a decrease in cash. For notes receivable, that means someone owes you money, so you lent money. So that would be, if you're lending money, that would be a decrease in the investment. But when you're receiving the payment from the organization that you lent the money to, that would be an increase. The last one is the cash flows for financing activities. And here you would look at your long-term liabilities and your equity. In this example, we only see equity transactions, and issuance of common stock would be a cash inflow, and dividends paid to shareholders would be a cash outflow. We could also see the sale of bonds payable. The sale of bonds would be an increase in cash flow because you're borrowing money, and the payment to the bondholders at the end of the term of the bond would be an outflow. And as you can see, we net the cash from operations and the cash flow from investing activities and the cash flow for financing activities to give us our net increase in cash. We take our beginning balance plus the increase in cash, so our cash balance at the end of the year is $54. The statement of cash flow, whether you use the indirect method or the direct method, does result in the same answer. It's just a different approach to doing this. If you have any questions, please email me your questions. I'd be more than happy to help you. But I've given you enough information here to get at least a better understanding to just read the financial statement of cash flows in this presentation. But I'd be more than happy to provide any additional information you may have.